flows are still shifting globally, and it could, of course, be interesting to see how the next few months pan out, and more on that shortly. Interestingly, Swiss investment bank Julius Baer has downgraded its long-standing constructive stance on US equities and is now looking out for opportunities in other markets, according to CNBC. In Asia, Julius Baer analysts said that they were overweight on Chinese equities, which are in a cyclical bull market, and Indian names, which provide long-term structural growth exposure. The head of equities strategy research at Julius Baer wrote in a note that with US equities in oversold territory and a short-term counter-trend bounce likely, they see it as an opportunity to further diversify into non-US markets in coming weeks. They also expect the rotation into non-US equities to persist in the case of a moderate slowdown in the US economy. However, they said a recession in the world's largest economy, which is the United States, is likely to also trigger a broader bear market globally, according to that CNBC report. So let's come back home to get a sense on how the markets are stacking up right now, including picking up from that 1,100 point rise, and what we could take away and importantly not take away from the action in the last few days or a couple of weeks. I reached out to veteran market analyst Ambareesh Baliga and asked him exactly that question.
So see, basically what's happened in the last couple of weeks was a very decent sort of a correction, which in fact we were waiting for a long time. It was not happening. Finally, we've seen that major correction coming. So what has happened is it's hurt a lot of retail investors, who are so used to markets moving in one direction. Whenever there were corrections, they used to buy in. And the theory at that point of time was buy on a correction, you'll never make a loss. And it's quite easy making money in this market. I think all that was thrown out the window in the last couple of months and especially the last couple of weeks. So as of now, I think the retail investors are completely bruised. As investors, as long-term investors, I think after a long time, it has given us an opportunity to pick and choose. Valuations, I wouldn't say are mouth-watering, but at least valuations have come to decent levels. And the best part now is that the analysts and smart investors, the expectations from earnings were decently high. If you look at FY24 and part of FY25, now I think the expectations have been watered down. So going ahead, at least the disappointments from the corporates may not be as high as what we saw in the recent past. If you talk of the macro numbers, they're still mixed, I would say. We are yet to really see an uptick. And what's happening in US, President Trump, is something which we don't know as to what he's going to announce tomorrow. I think we need to wait for April 2nd to see as to what really happens to tariffs, which, on India. Although people in the market are expecting that it could get postponed, it could get diluted. But then those are just expectations. We don't know what's going to happen. This sort of a rally which we have seen, I think it's more of a relief rally because after a huge correction, there has been some value buying. So now we are seeing some amount of short covering. So possibly we could see this rally continuing for a while longer. I'm decently sure that this is not a fresh bull run.
And I'll come to your strategy in a moment. So you're saying, therefore, that one thing that's clear, or it seems to be clear, is institutional investors are not expecting a big turnaround in corporate performance in the next quarter or maybe even a couple of quarters, or at least they've tempered their expectations.
They've tempered their expectations. I think that's the only positive takeaway because, corporate earnings cannot really move up overnight because we have seen a decent amount of slowdown and we'll never see a V-shaped recovery looking at the way things are played. But like I said, the only positive thing is that since expectations have been tapered down and market is all about expectation and delivery. So when the expectations have been tapered down, the delivery is not too bad, then people take it positively. So one can say that possibly we are seeing some sort of a bottom, although you can never call a bottom till it's made a bottom and it's moved up at least 8-10% from there. We have not seen that as of now. But I would hazard a guess that yes, we are seeing some sort of a bottom.
And your own strategy, and I know that you were very high on cash last year. So how have you approached this market?
It was tough sitting on cash, especially when you see the markets hitting new highs. And those 3-4 months from June, July to September, October was a bit difficult. But yes, I think that's paid off quite well because...
You were at about 40% cash at that time?
Yeah, we are about 40% in cash. But we have invested a decent amount in the last couple of weeks. And today we are down to 10%. We're keeping this 10% cash for eventuality. Because although I'm expecting that the markets should not really break that 21,800 to 80,000 band, but you can't be sure in the market. So anything can happen. So in case we see a breakdown below that, we'll possibly utilize this 10% cash. Or if I see a breakout beyond 24,000, which again I don't expect to happen soon, but in case that happens, I'll invest the balance cash at that point of time, because by then, if it has to break 24,000, then there has to be a good reason for it to break 24,000.
And how are you seeing foreign portfolio investor sentiment and action right now, given that their selling is really what has driven the market down to a large extent?
Yeah, I think that's going to continue at least for a while longer. But then I would again hazard a guess and say that possibly we are close to end of FIS selling. Basically because their holding in Indian companies, I think, is at a decade low or maybe more than that. One of the reasons for major amount of selling in the recent past was, one was clearly the valuations were high. The rupee had suddenly become weak. I think that is what forced them to sell, because there is a double whammy. I mean, you have markets coming down, at the same time the rupee is getting weak. So I think there was a rush to the exit gate. That became a stampede. But if we see the rupee stabilizing wherever, whether it's 86.5 or 87 or 88, it has to stabilize. So when it stabilizes and slowly you start seeing the macro numbers improving, you see the corporate earnings meeting expectations, better than expectations, hopefully, which should happen in the next 2 to 3 quarters. I think that's the time these FIs will again come back. Because end of the day, they have to invest in markets which are expected to perform better than the rest. And from here on, at least if you're talking of slightly longer term, I don't think there's any doubt that India will not perform. So India will be performing better than most of the other economies. So money, like liquid, flows in wherever the economies are doing better.
Ambareesh, thank you so much for joining me.
Thank you. Always a pleasure.